You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Our next speaker, called the Dallas Fed's resident soothsayer, Danielle DiMartino Booth, is sought after as a thought leader for her depth of knowledge on the economy and financial markets. Danielle is an advisor with the Federal Reserve Bank of Dallas and served 8 years under President Richard W. Fisher until his retirement this spring. She researches, writes, and speaks on financial markets, focusing recently on the ramifications of credit issuance and how it has driven equity and real estate market valuations. Danielle began her career in New York at Credit Suisse and Donaldson, Lufkin, and Jenrette, where she worked in the fixed income and private equity markets. Danielle holds an MBA in Finance and International Business from the University of Texas at Austin and an MS in Journalism from Columbia University. Please welcome Danielle DiMartino Booth to the stage.
Thank you, Patty, and thank you all again for your patience this morning. Wow, this is a bright light. I'd like to also thank my good friend Barry Nobel for asking me here to join you today. Again, my apologies for being late. Rick Santelli was on CNBC interviewing Bob Schiller about Yellen's comments yesterday. I got caught up in the moment and then managed to run out of my hotel room without my laptop and speech. So I don't recommend that. In any event, I'd like to dispense with the usual disclaimers that the comments I'm about to make are my own and in no way represent an official view of the Federal Reserve. And just to be safe, I should emphasize that what I'm saying is off the record. So, if we could pull up the first slide. What? There we go. Thank you. I've been on the road maybe even too much these last few months. Plenty of time on the tarmac and in the air have afforded me the luxury to reflect back on the economy over the last decade, most of which I've spent at the Fed under Richard Fisher, one of the greatest talks in central banking history. Of course, a lot has changed in the last decade. The housing bubble has peaked, and the worst of the great financial crisis has come and gone, though not without taking a few legendary names down with it. But the fact is, despite the carnage, not nearly enough has changed. Looking back further down memory lane to when I was on Wall Street during the build-up to the NASDAQ bubble, I was dismayed to realize that even since then, again, not nearly enough has changed, not in the big picture at least. Let me share a story with you to illustrate my point. Many of you will recognize this lovely little box as the iconic representation of Tiffany's jewelers. As it so happens, a story related to Tiffany's recently relayed to me by my great friend Arthur Cashin has proved immensely valuable in explaining to my 4 young children exactly what it is that I have been doing for Mr. Fisher all these years. I can easily tell an audience of adults that I analyze every aspect of the financial markets and how they react and interact with economic data to best advise my boss on the future direction of monetary policymaking. It won't surprise you that those words are meaningless to my 7-year-olds. This old story about Tiffany, the jeweler, though, and J.P. Morgan, the banker, happens to be so straightforward that it can easily convey the meaning of price discovery, which, after all, should be the sole driver of financial markets. Now, I know it's still early in the day, but you too will remember this story. Just give me your attention for a minute. Being the astute jeweler that he was, Mr. Tiffany knew that Mr. Morgan had an acute affinity for diamond stick pins. One day, Tiffany came across a particularly unusual and extraordinarily beautiful stick pin. As was the custom of the day, he sent a man around to Morgan's office with the stick pin elegantly wrapped in a robin's egg blue gift box with the following note. My dear Mr. Morgan, knowing your exceptional taste in stick pins, I've sent this rare and exquisite piece for your consideration. Due to its rarity, it's priced at $5,000. If you choose to accept it, please send a man to my offices tomorrow with a check for $5,000. If you choose not to accept, you may send your man back with the pin. The next day, the Morgan man arrived at Tiffany's with the same box in new wrapping and a different envelope. In that envelope was a note which read, "Dear Mr. Tiffany, the pin is truly magnificent. The price of $5,000 may be a bit rich. I've enclosed a check for $4,000. If you choose to accept, send my man back with the box. If not, send back the check, and he will leave the box with you." Tiffany stared at the check for several minutes. It was indeed a great deal of money. Yet he was sure the pin was worth $5,000. Finally, he said to the man, "You may return the check to Mr. Morgan. My price is firm." And so the man took the check and placed the gift wrap box on Tiffany's desk. Tiffany sat for a minute thinking of the check he'd returned. And then he unwrapped the box to remove the stick pin. When he opened the box, he found not the stick pin, but rather a check from Morgan for $5,000 and a note with a single sentence. "Just checking the price." Just checking the price. That, my friends, is how markets are meant to operate. Now, I'm sad to report that that is not how markets have operated for a good long time, thanks to what I like to call the obfuscation of price discovery that's emerged as a result of interest rates being held too low for too long. Obfuscation, which I can hardly pronounce, but have come to understand all too well, is defined as the hiding of intended meaning. The Latin root of the word literally means to darken over. How long have the markets been in the dark, so to speak? I'll reserve that answer to the end of my remarks, though some could argue it's being played out in the German bond market today. As for the most recent episode, we're over 6 years into price obfuscation. I said I couldn't pronounce it. That's how long it's been since policymakers voted to lower interest rates to the zero bound in the hopes of spurring a fully sustainable economic recovery. Surely there are fruits of the Fed's largesse. Well, I won't deny the improvement in the labor market, and there's no doubt the housing market has moved well past its darkest days. Consider the Miami market, where we are here, as a case in point. Step outside and you too can count cranes. That's a sport I thought I'd given up a long time ago. As an aside, I have to add one tidbit about Miami, which I appreciate is a special case: foreign dollars. Today, there are over 40,000 condominiums under construction in the planning stages in Miami. Anyone take a guess at the equivalent when the housing market was peaking in 2006? 32,000. But back to the Fed's closest friends, otherwise known as investors. For this Tony cohort, the fruits of the Fed's zero interest rate policy are bountiful on a record scale. Some $27 trillion has been tacked on to the collective net worth of American households since financial markets bottomed in March 2009. Investors faced with making no return on their savings have poured money into riskier assets, such as junk bonds and the stock market. The problem is the current rally has disproportionately benefited the 20% of Americans we always hear who control 80% of the country's financial assets. That's largely left behind the average household whose biggest asset was and remains their home. The $24 trillion in paper wealth created during the housing boom, as fleeting as it proved to be, again, paper wealth, was at least more spread out. What else has happened since housing prices peaked? Well, not a whole heck of a lot, gauged by the looks of this chart. Since May 2008, 7 years ago, per capita income growth, adjusted for inflation, has risen by 0.48%. In other words, the current generation of Americans is the first in the post-war era who've not been able to achieve the American dream of making more money than their parents did. Think about that for a minute while keeping in mind that the mother's milk of our country's growth is consumption. How have U.S. households managed to keep the economy growing at about 2% if their incomes have been growing at an appreciably slower pace? To answer that question, look no further than the same driver that propelled the economy to great heights at the start of this young century. Look no further than debt. While I'm sure everyone in this room can attest to the fact that there's nowhere near as much mortgage debt being churned out as there was during the housing boom, other forms of debt creation have eagerly stepped up to the plate. Despite the huge contraction in outstanding mortgage debt, household debt is within striking distance of its 2008 peak. I suppose the real story is the type of debt that's been responsible for backfilling the gap that opened up due to the nearly 10 million foreclosures that have taken place in recent years. Let's start with where the mortgage debt tailed off, that is, student loans, by far the fastest growing category of household debt in recent years. As the economy slowed, many students and displaced workers took on debt to finance the higher education they were hoping would allow them to weather the recession storm. The problem is, too few high-paying jobs were created while a record number of Americans hit the books in recent years, even as the cost to attend college skyrocketed. The end result? At the risk of inflicting death by numbers, by the end of last year, student debt, the left-hand graph, had risen to $1.2 trillion. Meanwhile, nearly half of all U.S. households are burdened with student loans, and the average balance has surpassed $20,000. The delinquency rate on this mountain of debt? A mere 11.3%. The subject of delinquencies brings us to car loans. Remember what I just told you about the conundrum of economic growth against a backdrop of stagnant wages? The picture becomes much clearer when you consider car loans outstanding are nearly $1 trillion. Outstanding balances have risen by a fifth over the past 2 years. The good news, only 3.5% are delinquent. Peek under the hood, though, and you see where growth has truly been phenomenal, to quote a recent Morgan Stanley report. Used cars were the second best performing area of consumer spending in 2014, clocking a nearly 30% growth rate, the fastest since the late 1990s. How did households, again with very little in the way of fatter wallets, manage to finance these big ticket items? Funny you ask. That brings us to the first and last time today that I will use a big word. Back in the late 17th century, Austrian economists identified a phenomenon they termed malinvestment. Ludwig von Mises expanded on the idea, writing this in 1940. The repeated attempts to render people prosperous by credit expansion, and thus the cause of the cyclical fluctuations of business, manifests itself clearly in the custom terminology. The boom is called good business, prosperity, and upswing. Now, I'm going to cut off Ludwig there and finish this definition in a few minutes. In the meantime, let's look at a few areas today that are all the rage in the financial markets, ones that personify the perception of prosperity. Since 2010, issuance of subprime auto loan-backed securitization has tripled in volume, topping $20 billion last year and bringing the total outstanding back to its 2006 peak. Some 73% of this paper backs used cars. Don't worry, the mantra goes, investors are being justly compensated for the risk they're taking on. I'd have to agree on that point. With interest rates upwards of 20%, it's no wonder over 8% of subprime auto loans underwritten last year were delinquent before the year ended. Maybe it's a blessing in disguise to lose a used car to repossession before pouring years and years of payments into an asset that depreciated before you even drove it off the lot. The problem is, so many of these folks who've accessed subprime auto loans are one and the same with those who are still upside down in their homes. A recent Zillow report found that nearly a third of those in the lowest priced homes remain underwater. In fact, owners of less expensive homes are 3 times more likely to be underwater than owners of expensive homes. In New York, they're 5 times more likely. It's hard to fathom these homeowners moving up to a larger home anytime soon, especially if their credit's been freshly impaired by a car repossession. Some markets shown on this screen, such as Chicago, Detroit, and Washington, D.C., are in particularly bad shape. Atlanta, for its part, is the worst affected market. Bottom-tier owners there owe at least twice what their homes are worth. Add up the elements of high student debt, entrenched would-be move-up buyers, and stagnant wages, and you land at the doorstep of the rental revolution. Reports that household formation had finally picked itself up off the ground last year were greeted with all manner of fanfare. The problem was there were over 2 million renters created last year, while there was a net contraction in the number of owner-occupants. You may be asking, what's so wrong with living in an apartment? Well, nothing, unless you consider how far off trend multifamily construction is compared to historical norms. As you can hopefully see, in a normal world, 4 single-family homes are constructed for every 1 apartment built in this country. Today, single-family construction is running at half that pace, which competes with the depths of the most recent recession. The question is, have we built too many apartments or too few single-family homes? I suspect most hope that the answer is neither nor. History, however, suggests otherwise. By definition, so many new renters translate into too few first-time home buyers. This is a subject we talk about endlessly at the Fed. The latest data for March showed that 30% of sales went to first-timers. It's hard to imagine that over half of the sales went to freshly minted homeowners just a few years ago. That said, their anemic showing was better than the 26% record low that ended 2013. It can't hurt that home price gains have slowed care of less competition from fat and happy investors. I wish I could say that private equity had truly exited stage left due to the dearth of foreclosed properties to be purchased. But the fact is they still have other people's money to spend with abandon, so they've begun to buy up non-distressed properties. Google non-distressed and Phoenix for an interesting story. To wit, you may note the red line on the graph. At 24%, all cash sales remain a formidable form of competition for first-time buyers. That's the funny thing about playing with somebody else's money. It makes it really easy to win a bidding war. Another poster child for the current era, mentioned by Chair Yellen just yesterday, is high-yield bonds. Half of outstanding U.S. corporate bonds today carry speculative grade ratings. Their share of the market has doubled over the span of the past 13 years. The question is whether the risk is being sufficiently rewarded. Consider that 11% of double-B-rated companies that borrow money for about 5% can be expected to default over the course of the next 5 years. Slide down the credit rating scale to triple C-rated companies. Almost half of them can be expected to default over that same period. So the question is, are today's investors appreciative enough of history? That's hard to say, because half of the $2.3 trillion in outstanding high-yield bonds has been issued in just the past 3 years. We've never dealt with a junk bond market of this size, to say nothing of what's happened with investment grade. And finally, there's the stock market. Some estimates suggest that up to a third of profit growth since the onset of the current easing campaign is attributable to the decline in interest expenses. That's plausible enough if you do the math. But there's a much less obvious and yet more powerful support powering the stock market. Since 2009, companies in the S&P 500 have bought back over $2 trillion of their own shares. To put this dollar figure into perspective, over the same time frame, ETFs, foreign buyers, insurance companies, mutual funds, broker-dealers, private and public pensions, hedge funds, and households combined haven't even made $500 billion in aggregate stock purchases. Companies outnumber the rest of the universe by 4 to 1. Narrow it down to what we consider to be mom and pop, small or retail investors, whatever you want to call them. This crew has all but abandoned the stock market as gauged by a recent Citigroup analysis. Over the past 10 years, buybacks have outpaced mutual funds and ETF purchases by a factor of 40 to 1. Now, I'm just guessing here, but do you think there's an outside chance that retail investors don't believe their interests are aligned with the guy in the corner office who hasn't flown commercials since Reagan was in office? The problem is looks can be deceiving. A famous market veteran recently observed that companies have raised financial engineering to a Botox state. I couldn't agree more. You tell me what old Ludwig would say of used car subprime ABS, of the multifamily construction mania, of single-family rental bonds, of super junkie bonds, and of monkeying with your balance sheet by buying back shares instead of creating shareholder value the old-fashioned way, by investing in profitable ventures that grow your company from the inside out. Well, I can't channel Ludwig's voice, but I can tell you that his words capture what we see day in and day out on CNBC. And I quote, People rebel against the malinvestment and the overconsumption of the boom period. They deny that such an artificially induced boom is doomed. They're looking for the philosopher's stone to make it last. Ring any bells? Of course, all investment manias start out with the best of intentions. Take the shale revolution. With all due deference to David Einhorn, what's not to like about the idea of energy independence? My greatest fear, with the caveat that I hail from the great state of Texas, is that one of the primary drivers of the recent growth that we have seen in the macro economy stems from the shale revolution. Suffice it to say, I worry about the third of capital expenditures tied to energy investing in recent years, to say nothing of what you're looking at on this screen. Nearly the same amount of non-residential structures built last year, some 29%, was attributable to the oil patch. That came as news to me. Now, let me be clear. I am not saying that investing in the eventual energy independence of this country is malinvestment in its truest form. I will nevertheless suggest to you that too many dollars chasing too few shale investments subjected the sector to overinvestment. Some of you may recall that it wasn't the drop in oil prices that proved to be economically devastating in the 1980s. It was the carnage that followed in the commercial real estate market that did the economy in, especially in Texas. It therefore came as somewhat of a surprise to me to hear that Houston had invested more heavily in the current oil boom. I'm sure many of you saw the Wall Street Journal article a few weeks ago that cited Houston as home to 1/6 of all office development currently under construction in the country today. Now, like many Texans tracking the price of oil obsessively day in and day out, it's just south of $60 right now. I'm hoping that the decline in oil prices is short-lived, mainly so we can retain a lot of the high-paying jobs that have been created by this energy boom. Since 2009, wage growth across all 50 states has averaged 0.8%. Most of the oil states, though, you can see they've got rigs on them, have outperformed the country as a whole. It would be nice to imagine not losing many of the higher-paying jobs that have been created in recent years. A recent Deutsche Bank report aimed to expand not on the potential downside to lower oil prices, but rather the economic benefits the economy has enjoyed since the advent of the shale revolution. If you can surmise what the fruits of the economy have been, you can thus take a stab at the damage that will be wrought in the absence of the additional boost generated from shale drilling. Let's start with the broadest gauge of economic activity, GDP. Since 2006, shale states have grown at 3 times the rate of non-shale states. The unemployment rate in the shale states is 4.9%. That compares to 6.2% for the rest of the country. To add some more color to shale states' labor markets, had payroll growth been on par with that of the rest of the nation, 2 million fewer jobs would have been created since 2006. The Deutsche Bank analysis found that multiplying these 2 million jobs by wages over the period comes to about $78 billion. The economic benefit from higher payrolls, however, only conveys half the story, and this is something we debate day in and day out at the Fed: wage inflation. Had hourly earnings in shale states run at the same pace as the national average, the annualized amount of lost income per worker would have been $1,800 a year. Looked at through a positive prism, the incremental wages accrued to shale state employees summed to $51 billion per year. Lots of numbers, I apologize. Remember that the sum of the two is $129 billion. $129 billion per annum at the margin in economic benefit. If you add up how much consumers benefit by lower prices at the gas pump, it comes to $120 billion per year. We can only hope that shale workers were prescient enough to save some of their outsized incomes. As for retirees' prospects to realize their own American dreams, forget about the baby boomers for a minute. Dismiss the findings of a new report that the typical working household with a 401k approaching retirement has only $111,000 saved. The reality is 60 is the new 40, give or take, and many of these people are going to continue working for years to come. But what about the ranks of Americans who really need to retire after a lifetime of work? Over the next 25 years, the population aged 65 and older is going to swell by 38 million. nearly double that of the growth of those aged 20 to 64. Call it the housing hangover. 4 in 10 seniors over the age of 65 still have a mortgage. The median mortgage debt for this cohort is just over $80,000. Young and old alike, one has to wonder what the future holds. When will households own up to their addiction to debt? Well, that sounds pretty derogatory. I suppose the answer comes down to when it will actually pay to save. And yet here we sit, with interest rates firmly planted at the zero bound, though the hope is that policymakers are finally ready to lift interest rates up off the zero bound. Maybe, just maybe, the time has come to normalize interest rates. It wouldn't be such a bad thing, especially if it pulled the plug on malinvestment. And yet I have my doubts. This particular audience will appreciate this new little statistic I stumbled across. The December Fed Funds futures contract, which gauges the likelihood that the Fed's going to hike by year end, is at the lowest yield that it's been at since it began trading in 2012. The market, in other words, has serious doubts will lift off this year. Where does that leave me? Let's just say I'm bullish for bearish reasons. In the event you can't read the window of the China shop that this bull has just rampaged, it says UK economy, where we all know elections are taking place today. As for the bull, he's screaming, "Leave me alone, you'll wreck the recovery." Of course, this could easily apply to the US economy. As I'm sure you've all heard, it's been quite the recovery, at least as far as longevity goes. At 70 months, the current recovery is the 6th longest in data back to 1850. What's truly uncanny is that all 4 recoveries that start with the Greenspan era are extraordinarily lengthy, historically speaking. A happy corollary, as pointed out recently by Jeremy Grantham, is that the average price-to-earnings ratio on the S&P 500 in the post-Greenspan era has run at 24.4 times. That compares nicely with the 14.4 average PE that held from 1900 to 1987. As for the economic spoils of the era, we all know about the few, the proud, who've been able to cash out at the peaks and buy in at the troughs. For the rest of the country, Greenspan will be immortalized, I dare say, for coining the phrase jobless recovery. The added bonus of the current recovery, let's just say it's on the growth light variety. Historically, the 3 cyclical sectors of the economy, consumer durable spending, housing and business equipment spending, have collapsed during recessions and then charged ahead during recoveries, but not this time. Today, all 3 sectors have recovered only about half of their decline as a share of GDP. As for the price tag for this anemic recovery, that would be about $4 trillion. That's what the Fed alone has spent trying to spur economic growth. You tell me if that's money well spent. Will lower for longer make this country stronger? I seriously doubt it. Uninhibited price discovery is the bedrock of a free market economy. Lower for longer inhibits this natural process. Saving today, sacrificing today to ensure a better tomorrow. These are the disciplines that helped foster a superpower economy. But the fact remains, lower for longer has ravaged those who dare save, while richly rewarding those engaged in reckless investment behavior. I'm here today to tell you that the current era has outlasted its welcome. Lower for longer may endeavor to revive animal spirits by making debt so cheap for so long that it's impossible to not play along as market participants. But nearly 30 years later, in the wake of one speculative boom and subsequent collapse after another, I'm afraid to say that we haven't learned nearly enough. It's not the creation of debt that makes a lasting impact on economic prosperity. Rather, it's investment in the future that promises to retain its value for generations to come. And with that, if I have a few seconds, I'll take a few questions. I'm not sure what my time is. I'll take maybe one question. You're hungry. Well, I will be joining you in the cabana in a little bit. If you've got any questions then, you can certainly feel free to ask me. Thank you for your attention.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.